Welcome to the Options Income Blueprint Weekly Income Report on April 18th, 2022. It's Boston Marathon Day. It's tax day. Two different ways of looking at the day. Reminder, next trading sessions tomorrow at 11 o'clock Eastern Daylight Time. I'll go over trades and results from last week in a moment. A little bit of time on Squarespace and trading silly puts, one of the favorite kinds of trades among members across all my services. Last week we closed one position. We sold our Squarespace shares at a considerable loss. It was hurtful, but one of the things I want to say is that this happened because of not one, not two, but three hits to its category of stocks. The company is still in very good shape, but sometimes you have to turn your back on a stock when Wall Street changes its valuation metric, and Wall Street did here. It changed the way it values high price earnings multiple stocks. We got into the stock after a very successful earnings announcement. It popped, it settled down. We got in, next leg up. Then all of a sudden concerns about interest rates hit that sector of high price earnings multiple stocks. Then interest rate increases hit that sector, then Ukraine did. So we took a loss. Now, how are we going to track this? And this is very, very, very important. I track positions, which of course include multiple trades until it's closed. I don't track what we do here as a portfolio. There's no point. Most members, this is a subset of how they invest or a subset of how they trade. Many change the specifics of the recommendations, alter strike prices, close late, close early, do spreads, what have you. The way I know the research that I do is on track, pardon the pun, is by the percentage of successful trades. And that's been consistent for 10 years. It's in the mid to high 90s. And even during the great crash of a couple of years ago, across both services, 600 and something trades, we closed 5 losers, all related to travel. This is a different situation. We have a more elongated, difficult time that we've been in, but there are times to move on. Now, the second thing you need to do is to track your cash. I do it, you do it, but in this case with Squarespace, it's a significant capital loss. What I'm recommending you do is take a look at the cash, the profit that you have coming in, and apply that against your capital loss from the trades in the service. And when you're at break even, start tracking again as cash coming in to truly take a look at your performance. Speaking of cash coming in and income, we generated a lot of cash selling new positions or rolling positions. We sold 3 new positions, General Motors, Trade Desk, and Skechers, and we rolled to Sunrun. Now you'll notice that GM and Skechers and Trade Desk are in different sectors, but Trade Desk is of particular interest to us, and I'll get to that in a moment. And in going to goal, we did just fine, thank you. Again, I track cash. That is my primary interest because people who've been in the service for a while understand if you do enough in cash every week, every month, every quarter, every year, it overcomes whatever downturns there might be in the market or losses you may take on one specific position. And this is summed up sort of best this way in terms of taking a look at how we're doing. Now let's take a look at the market and where it leads to a change in tactics or an addition of a tactic. We seem to be moving, let's not mitigate the comment or water it down. We're moving more than 1% in a given day, a lot. And it's very good for option sellers. We benefit from this volatility, but how do you write out the 1% down days? If it happens on a Thursday, it can force you to roll. If it happens on a Tuesday, you can close early. So you have to marry your short and long-term thinking. The long-term, of course, is great companies and great stocks. Short-term is how are we going to trade this week? It's tough. It can be tough, but it can be great, too, at the same time. And it becomes really difficult if you don't have goals. If you haven't set a goal for your portfolio, which translates, a structure to your portfolio based on a cash goal. You have a cash goal, you want to do 20%, 25%, 28% a year. You structure your portfolio to do that, and you start tracking the cash coming in about whether you're going to get that rate of return on capital. And sometimes you make adjustments in the tactics to get you there. And one of them is by adding to our weapons, to our quiver, so to speak, is the silly put. What are silly puts? Puts with strike prices that are well below a stock's share price. For puts 1 to 2 weeks from expiration, that's getting out of brass tacks here, it's preferably a strike of 10% or more below the current share price. For 3 weeks or more from expiration, something 15% below the current share price. In today's market, I would be uncomfortable doing something 3 weeks out for obvious reasons. Now, there is a very limited universe of option chains that have these characteristics. And this is not about algorithmic analysis, implied volatility, beta, or whatever. It's a guideline, but it's a good one. It's a good one for do your own searching and so forth and so on. Sometimes you can find a monthly 25% out and so forth and so on. So you start where you always start, which is the question is 10% a rule or a guideline? Well, let's say it's 8.5% out. What do you do? It depends on the company, the stock, the charts, the construction of the trade itself. Nothing is in isolation, but the chart should indicate support below the strike price. Now, I've been using the 20-day, and this is Trade Desk. We put it on last week. This is the 20-day chart, and we started at 66.64. We're at 67.43. That's pretty good considering what the market has been doing. And what's really interesting on a very volatile stock, you can see we went up to 75 and back down to about 62. So you do have almost a 20%, 25% delta change between the high in the 20-day period and the low. So we took a look at this chart. I took a look at this chart. I also took a look at the 30 and the 90 and the 6 month, but a lot of that's distorted because it trades violently around earnings, and opted to sell the $59 strike, which is not 10 but 12.5% out of the money. So that's what we did, expiring this week. It's less than 2 weeks, 10% guideline. We collected 68 cents, $68 a contract. That's a 1.2% potential return, and more importantly, the way we measure these things, is a 38% potential annualized rate of return. That is very unusual. Silly puts I usually shoot for between 18 and 25%. It's just one of those very good companies with a very, very hot and volatile stock that the stars were in alignment. I took a look at it. I follow it every day, every week, and it was time to do something with it. Here's the actual alert in case you're new or in case you didn't look at your email last week or you didn't make the trade. Just to show you that all the data was there. You had a pretty wide spread, 63 to 74 cents in what you were looking at to set the trade in place. So the Silly Put universe itself is a pretty small group of stocks. They're very volatile. Obviously, avoid earnings week, avoid FDA announcement weeks, avoid competitive announcements. If Coke is announcing earnings, you don't want to own Pepsi. And this universe expands if you include stocks that only offer monthly options. It expands significantly. And I don't do them here unless we're 2 weeks before expiration, maybe a little bit longer. In a different market where you're trading no more than, on average, 0.5% a day, we would put more monthlies in, but not right now. And when you're trading them, don't get seduced. Oh, wow, this looks like a great trade. Do your homework on the company and the stock. Send me an email. And the flip side is you be aggressive. If something like Trade Desk is offering you an opportunity to sell something $9 out of $8.5 out of the money, do it. And you have to be prepared to roll out or up. And what do I mean by that? Rolling up means we sold at 59. It's Monday. Maybe on Wednesday the stock has popped or is moving up more. There's no events in sight. So maybe you buy back to 59, and let's say the stock was at 69. You buy back to 59, maybe you sell the 63 or the 64. It would depend upon the 3 and the 5-day charts and where volume lands on those days. But you can do that. It increases your cash and increases your rate of return. So going forward, I hope to find and use more Silly Puts. The Trade Desk is rare. There are more that can go 10%. Out of the money. That was 12.5. And sometimes I'll do 8.5 or 9. And sometimes they don't work. When you have a giant movement of flows, let's say banks to high tech and high tech to banks. We saw this last week when high tech got hit as some banks picked up some investors. Even companies like a Microsoft, went down 5%. So Microsoft is not normally a candidate for Silly Puts, but if it does that over and over and over again, it may start to creep into that universe of 7 or 8%, and maybe 8% down on Microsoft is a really good trade because it is Mr. Softy. And with any market stability, you'll see these to be longer dated coming from me. But right now, when we do them, they'll be short term, under 2 weeks. And please remember, the emails I get, you have to be willing to own the shares. You can't do anything that I've been discussing in all these updates by saying I can't accept assignment. If you can't accept assignment, you can't sell a put. It's not really complicated. And to stick to your goals, be it a silly put or a regular trade, you have to use, or you should use, good until canceled orders. Keep an eye out for alerts. I'll be putting out alerts to specify if we're rolling a silly put up. And if you have any ideas, something you see, of course, send me an email. I'll check out the company, check out the stock, and maybe I can steal your idea and recommend it to members. This is Michael Schulman. Thanks for listening.